Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Back today to talk about a new position in the eToro portfolio, and one that I had promised I'd do an overview on previously. We are talking about Icahn Enterprises. If you're new to the channel, I would greatly appreciate you liking and subscribing. And if you haven't already taken a look at the portfolio on eToro, head over to eToro and add us to a watch list, or if you've got funds that you'd like to use to copy a value portfolio, you can consider that as well. Today, we're going to be talking about Icahn Enterprises and why I'm interested in this particular position, as well as how it fits in with my expectations as to global macroeconomic environment moving forwards. Without further ado, let's get into it. Some quick facts on the company. Revenue expected to come in this year just shy of 14 billion. CAGR is flat to negative over the last few years. It's a very particular type of business. It's not what you think, and I'm going to explain that in a moment. EBIT is expected to be 1.6. They've been able to grow that at 8% CAGR, and how that is how this has been structured in its partnerships. Market cap, 17.7 billion, enterprise value, 28.8 billion, and the price as at the close, $54.89. 323 million shares outstanding. Net debt to EBITDA looks very high at 7 times, but this has been structured that way for a reason. Free funds from operation to interest coverage is 5.4 times. So very good interest service coverage ratio. They own a lot of real estate, and they're structured as a master limited partnership. So as I'll explain in a moment, what Mr. Icahn and co have done is they've structured this such that they will reduce the amount of earnings on paper that is visible and taxable, and distribute it as much as possible via distributions, some of which may be considered dividends and some may be depository receipts, which we'll look at in a moment. What gets everyone attention with this particular holding is its current yield is around 14.6%. Which is obviously very attractive from income investors' point of view. But just remember that is a distribution yield, not always a pure dividend yield. If we take a look at the price action over the last year or so, as you can see, we're on the high end of things. I believe we're currently going through a bear market rally. I expect stocks to continue to experience selling pressure. The S&P is tipped over 4,000. I don't expect that to last. I expect in a continually rising interest rate environment, along with a rising inflationary environment, that is going to be bad for margins, and we will see earnings start to fall as we've seen multiple compressions. So I'm very particular about where I'm positioning the portfolio, and we're running a large amount of cash. Having said that, if we were to see some of these troughs, I would look to add and start to build out a position in Icahn Enterprises. If we look over the maximum that TradingView will allow, you'll see some huge spikes, peaks, and troughs. And what we're looking for is an ability to evaluate the company, evaluate where they operate in which particular sectors, and work out how sustainable that distribution is going to be, and what price we might be willing to pay for that when we marry up the income valuation and the net asset valuation of all the particular holdings of the company. This is an interesting article that I read recently about Icahn's performance versus Buffett. If you look at the last 20 years, it suggests that they've been fairly analogous with Berkshire and IEP performing at roughly the same, albeit Berkshire more steadily, and Icahn having a little bit more volatility. However, when you take into account the dividend or the distribution that's been dished out through Icahn Enterprises, that suggests a further outperformance that would basically double the performance of the particular company. So the price hasn't really changed in terms of a nominal price quote, but when you add in the dividend, it's interesting to see how that changes the performance. When I want to make something clear. And so when I talk about diversifying risk as opposed to diversifying, what do I mean by that? Let's just keep it super simple. If we're talking about diversification, we're talking about ruining a good opportunity, essentially, like snatching defeat from the jaws of victory, in the sense that we have a good opportunity, and instead of having the strength and courage of our convictions to invest in that opportunity, we decide to get distracted by bright, shiny objects elsewhere, and we invest in lower quality assets. Okay, that's a trap, and we tell ourselves that it's safer because of diversification. But it's not in the longer term. If you know what you're doing, and you're looking at a rational valuation, you're better off looking at a more concentrated approach. And that doesn't mean only having 2 or 3 positions. But what it's looking at doing is avoiding diversification, and so something like buying everything in a given sector just for the fact that you want to diversify, in quote unquote. Then you're looking at things like ETFs, you're looking at index funds. These have had a phenomenal run over the last few decades because they were starting from a base effect of 0, essentially. There were no index funds prior to their initiation. And so you've had this passive investing theme. Now what you're looking at is you're looking at indices such as the S&P, where the majority of the valuation is made up by these tech stocks, which are the valuations for which you're paying 20 and 30 times. And when you start to see those particular companies that are performing very poorly from a free cash flow yield, they've been bid up just passively, I think we're entering into a situation where we will see this trend reverse, and you'll see things, just as an example, in the energy sector making a huge percentage of the index's earnings, and yet accounting for a very small percentage of the index weightings. Whereas it's the opposite, where you look at the heavy tech stocks are making up the majority of the weightings of these particular indices and ETFs, and yet they're accounting for basically, a very small percentage of the earnings. And that cannot continue, and what cannot continue indefinitely must eventually stop. And in this case, I think the capital flows will reverse. And then buying everything in a particular sector. So we're not just talking about broadly diversifying over the MSCI World Index, buying every publicly listed stock in the world. If you decide that, okay, you like the energy sector, but you go and you just buy everything blindly, because it's been so beaten down, that might give you quite good returns. But there's a more intelligent way of doing something. I mean, if you're looking at 100... if you decide that soccer is going to be a great sport, and so you go through and find 100 soccer players, and you just buy 100 soccer players for the sake of it, whereas you could just buy let's call it the 15 best in the world, I think you're going to get that team of 15 will outperform over time. And so why buy the 10th best option in a given sector when you can buy the best? It doesn't really make a lot of sense to me. It doesn't mean you only buy one thing, and I'll explain how I have applied that approach to the eToro portfolio, but it doesn't mean that you buy a sector ETF, whereas passive funds, again, they may do well simply for the fact that oil and gas, for instance, is so ridiculously undervalued. But over the longer term, instead of buying 100 different positions, you most likely would have been better off picking the best 10 or so and going with those if you really wanted to take a sector approach. So intelligent diversification, what does that look like? So gaining exposure to selected sectors, for example, without diversifying. So 2 is 1 and 1 is none, old saying from the SEAL teams. 2 is 1 and 1 is none. So if you have one position, you better be right, obviously. And when we're talking about a situation where we have such tension geopolitically and jurisdictionally, I don't think it's necessarily the smartest idea in the world to think that you know everything and that you put all your eggs in the one basket in one sector. And there's no law that says you have to do that. And so I'm not doing that. So here's how I would approach, or how I am approaching it. Looking through a given sector, finding my favorites, and finding a few choice companies that can provide diversification. So if I say, okay, let's say I want to allocate 30% to energy, and these are just arbitrary numbers, okay, and 20% of that is going to oil and gas, then I'll go through and find maybe 3 or 4 names to which I want to allocate that will make up that 20%. So I'm sure you're following. So a few choice companies can provide diversification of production of the commodity. So if we're talking fossil fuels or hydrocarbons, What's the mix of the companies, liquid to gas? Are they a shale play, which are really more of a oily gas play, or are they a Canadian producer that's a pure a heavy sands play, or they're mainly an oil play with a little bit of gas mixed in? What's your view? Are you more bullish on gas? Are you more bullish on oil? That might influence where you allocate your capital. Their position in the various value chain. So are we going to buy everything in the upstream? Are we going to buy everything in the midstream, everything in the downstream? What are we going to do? We're going to look at a company like Cenovus, for instance, and that's why I really like Cenovus, not just because it's fundamentally very cheap and undervalued, with a large cap, one of the very few large caps, a large amount of liquidity that's trading it in my estimation, certainly no more than 3 times the free cash flow. And the embedded optionality on that is that it's got access to refinery capacity. So it is a fully integrated, having merged with Husky, it is a fully integrated company. And so that one company also provides various diversifications in its operation. Geographically, so that we can get some geographic diversification. So Cenovus being in Canada. In the eToro portfolio, we also own Callum Petroleum, which again, on a fundamental basis, I believe is extremely undervalued and based mainly production wells in the US. And then Petrobras, Petróleo Brasileiro, which gives us some exposure to that Brazilian and emerging market economies, which is great. But it also takes risk. So here you can see we haven't bought everything. We haven't bought the ETF in the entire sector. You could do that. It's okay, well, it won't hurt my feelings if you believe that a given sector is so undervalued. But if you take a look at the production, transport, and refinery capacity of Cenovus, trading at, let's be conservative and say a 25% free cash flow yield, then you have Callum Petroleum, which I believe is due for a double. I think it quite comfortably over the next 1 to 2 years can hit $70 per share, and over the longer term, somewhere around 140, 150 in the US. And then Petrobras, which has got a ridiculously large dividend yield and super high free cash flow yield. You've got diversification across the main countries in the Americas. Why do you have to go and buy 100 other things necessarily? It's not to say you might have a little 1%er in something like a EPF in Argentina, somewhere that is just ridiculously cheap, but you've got a hell of a lot of risk, something with a lot of torque to the upside. You've got a lot of intelligently diversified exposure to the sector that you want without having to then go and diversify such that it would dilute your expected returns. So I guess that's the summary in short. Currency diversification goes along with that, where you have, in the case of Cenovus and even more so in Petrobras, they sell in US dollars and they pay their overheads in a weaker local currency, at least at the moment. So profit margins for Petrobras is out of this world at the moment. Another idea is longs, providing long short in the portfolio. So you don't have to necessarily take out short positions if you aren't able to do so. And I don't necessarily have to short and have that negative carry. I can simply look at the portfolio, look at what I like longer term, ignoring short to medium term fluctuations, and I can structure the portfolio such that 2 positions are both long, but they can offset each other if one or the other gets out of whack. So an example might be coal and steel, where both the valuations stack up. I like both of the fundamental valuations for CID, National Steel Company of Brazil, and Arch Resources. And so 1 or 2 things are going to happen. So coal prices, for instance, might continue to rocket to the moon, which is going to squeeze, and the US dollar might continue to march upwards. That's going to squeeze the hell out of the margins of CID, and so that might perform quite poorly. I'm not particularly worried because I bought it at 30% free cash flow yield. Or the opposite might happen. We might see a miracle and people start to produce more coal prices come down, Arch's margins are not as good. Again, I'm not worried because I paid 1 times cash flow for this business, but that will obviously provide cheaper input costs for steel makers around the world. And so they'll perform a little bit better. So there you can see it as kind of a seesaw. And as long as you're happy with the valuations fundamentally for both of them over the long term, I think it's another way that you can intelligently diversify. Another underrated way is regular income via dividends to provide future optionality on that capital. So what does that mean? Well, the world at the moment may look completely different to the world in 6 months' time. So if you're getting regular income via dividends, you can adjust your strategy with new income accordingly as you go along. Competent management with good history of capital allocation, that allows the company itself to diversify depending on the environment at the time. If the market drops and their shares are too cheap, they might buy back more of their stock rather than dish out a dividend. Or in the case of various commodities around the world, commodity prices are not where they need to be, or valuations on companies are not where they need to be, such that they feel comfortable in investing more capex in exploration and production, and so they divert their capital allocation elsewhere. Okay, so Icahn Enterprises, here's a brief overview. It's a master limited partnership with investments across investment and trading, energy, I really like Cheniere Energy, automotive, food packaging, metals, real estate, home fashion. Okay, so these are all industries in which I would be comfortable moving into a higher inflationary environment. Here's what that looks like. So GPLP structure, not something you see in Australia. This is obviously a US operation. Another thing to notice is that this is a really good sign in terms of management is on board with the performance of the business, because management are the owners of the business. Okay, so this is how they structure it into a holding company, or holding LP technically, and they have various percentage interests in their various subsidiaries here. Okay. Here's a track record of their dividend yield. So you can look at the amount distributed, and it's distributed as a distribution or a depository receipt. So that can be the shares or cash. That's at the discretion of the board. Okay. Yield. Okay. So healthy yield, track record of a rather healthy yield, and not too much else to say. If we take a look at a few things. Okay, so there are a few issues with this. It seems way too good to be true that you're just going to get nearly 15% dividended out to you. And that's because, as I mentioned, it's not strictly cash if the board doesn't decide it to be so. So November 1st, 2021, IP board declared a $2 quarterly distribution payable in cash or additional units, and that's at the discretion of the board. So my question is, will that risk the dividend? Will that risk dilution? Something that I don't think it's the end of the world, but I think it's just something to keep in mind. The other thing will be, okay, we take a look at the income and we can value it as a bond, and I'll show you how to do that in a moment. But what's the value of their assets? Little tricky because of how they acquire their assets. So they write, for instance, they have a warrant in Occidental Petroleum. They've sold some of their shares, but they hold a warrant that can convert, I believe, somewhere in the 20s. And so obviously that would have an immediate 300% upside. Do they account for that as a $20 per share asset? If so, this is going to be extremely understated. Okay, so bear that in mind. It's not easy to figure that out from the financials. So if we take a look at their indicative net asset value, and I believe what they have done is use the valuation at time of purchase. And I'd be interested to hear from anyone that has anything else that I can read up on this particular company and how they structure their accounting. So at the moment, that's suggesting a net asset value of, call it $20 a share. So they're trading at more than twice of that. And so I'd be a little bit cautious from a NAV perspective. If we were to see a drop in price and we could buy it at roughly 1 times NAV and get that dividend yield, then I would heavily start to allocate capital towards this company. As I said, though, if you were to go through and really dig in and find out what valuation are they using in their accounting here, this may change significantly. That might double. And so you'd be paying just a little bit more than 1 times NAV. Not easy to figure out. Then you look at the debts. Well, some of those debts, of course, are on the real estate. And so should you treat that the same as you would an operational debt? These are all the questions that you may have. And so you may exclude some of these and come up with a very different estimate of net asset value. Okay, so totally acceptable or subjective from that standpoint. I wouldn't necessarily argue till I'm blue in the face that this net asset value is what it appears to be in terms of face value. So in the investment thesis, I've tried to keep this super concise here and say in 3 things what the idea is. So it's an intelligently diversified holding company, as I've just defined intelligent diversification in the previous slide. We have quality management. We have the activist Icahn family running things that I'm very comfortable with. I'm very happy to have people that aren't afraid to shake some people by the collar and make sure they're doing what they're supposed to do instead of just writing themselves expensive compensation from the executive board. Reliable, regular, and growing dividend yields at 14% plus. So here's the key. If we use that as our fulcrum assumption, that's what we're going to use to value the business. So if we value this essentially as a bond and value the distribution stream using the Gordon growth model, I call them fulcrum questions. So how reliable is that distribution? How much can it grow? Can that give us our IRR target standalone without having the equity price increase, or without having to rely on the price of the share increasing? What optionality does the payout schedule provide us? Okay, so these are the questions that you would have to answer and satisfy to come up with your investment criteria. So this is just how I would look at things and say, okay, let's assume that they can continue this $8 a year distribution. Okay. What can they do in terms of growth? Can they grow roughly in line with GDP? So 2% over the longer term. If we look at our target rate of return as 17% as a discount, then you could pay up to $54.40. So roughly where the shares are in line now. So if you believe that they can continue to pay this out and grow it at 2%, and you're happy to receive 17% year on year from the dividend alone, and you might get some equity appreciation depending on market fluctuations, then you might say, okay, I'm happy to allocate a fair amount of capital to that now. So what I've done is I've started to open a position, but I would like to pay less for it, because there's this uncertainty around the NAV and there's a little bit of uncertainty around the reliability of that distribution stream moving forwards. Okay. I'm not against being given more shares in lieu of a straight dividend, but depending on your taxation situation around the world, or what your stage of life is and what you're looking for, that may or may not, you may not like to have that decision removed from your choice. I don't think it's the end of the world, but it's something to keep in mind. So again, if I've used the same distribution and growth assumptions, but I discounted at 20% and say I want to get my 20% IRR from the dividend alone, regardless of what happens to the share price appreciation, then you would need to buy below $45.33. Okay, it's fairly straightforward. You're just putting in what you think you can get as a dividend. So I'm using their current dividend and assuming that they can grow it at roughly the rate of GDP. So if we were to see a sell-off, and I believe we will see more sell-offs coming into the year should the Fed continue their rate hike course, then we will keep an eye out on Icahn Enterprises. Anywhere around here, I'll be starting to add to the position and build it out a lot further. So my verdict is a hold. So I'm not selling. I'm not buying. I have opened a very small position, and I'm looking to add on a pullback. So does it have low debt? Not in terms of the balance sheet, but in terms of the serviceability, and that's due to the way that they structure their accounting and their real estate. So they can easily service their interest, but if you look at the balance sheet, it'll show quite a large amount of debt. Margin of safety, that's questionable depending on what the net asset value is. Sales growth, kind of, but it's not the way that they structure. If you look at their margins, yes, they've grown that. I expect them, in the types of businesses they're in, I expect them to do very well over the next few years. Cheniere Energy is set to really increase the amount of export and play on export of gas from the US to the rest of the world. And you all know my thoughts on the gas market at this point in time. So I think they're going to make a lot of money from that. Their ability to grow the free cash flow is there. They may not show that on the accounting books for tax purposes. And so that's something that you just have to get your head around in terms of how they allocate that free cash. If you have confidence in the management team, then you should be okay with that. And then we have our share buyback. So this is the X. I don't think they'll look at really buying back a lot of shares unless there's a huge market, more than a bear market. There's a huge market crash. I'd be aiming for anywhere from 1 to 5%. I think I've got about 0.2% as a starter to build out the position. I'm waiting for a price drop, guys. If we start to get anywhere around the sort of low 40s, I'll start to build this out more towards the 5% in terms of AUM. Anywhere around a 10 to 15% distribution yield, I'm very, very happy with. Might get 2 to 5% upside on the equity price over the longer term. We'll see how it plays out. Thanks very much for watching. If you haven't already liked and subscribed to the channel, I would appreciate you doing so. And if you haven't already taken a look at eToro, download the app, click on the link that I will leave in the description. And if you're looking to copy a value fund, you can copy the portfolio that I run. Or if you just want to add us to a watch list, you can do that as well. I'm also on Twitter at the ROI channel. Disclaimer, guys, I'm not a financial advisor. I don't know your circumstances. None of this is to be taken as advice. This is just my opinion. They're my thoughts. Think of it like a video journal. I write in my diary what I'm thinking and what I'm doing. It doesn't mean that it's right, and it doesn't mean that it's right for you. So please take that seriously. Your capital could be at risk. So do not rely on anything that you hear me or anyone else on the internet say, for that matter. Go and seek professional advice, and remember that all decisions, you are responsible for your decisions and their consequences. Having said that, I hope that you enjoyed the video, and I look forward to catching up with you in another video shortly.